I mentioned earlier about the importance of having a balanced portfolio for options. Now, the key to that is having, great ETFs, but also very good stocks. And how do you identify good stocks? So there are four key attributes that professionals look at. I show you a framework for how to do that. So of the four, the first one is quality. That is a very important attribute of a good stock, of a good company. Now, quality means good balance sheets, the quality of its earnings historically, etc., which we'll go into in a little bit of detail in a second. That's number one. Number two is value. So value being PE ratios, price to sales ratios, etc. Number three is growth, the growth prospects of that company. Okay. And number four, to have momentum. Okay. So let's drill down a little bit into each of these four attributes, because actually, when you find a good stock, a good company, in an ideal world, it would have all four of these attributes. That's unlikely. Sometimes it happens. And when all the stars are aligned, you can find beautiful opportunities which have all four of these attributes. It's rare, okay? But it does happen. But look, if you find two or three attributes, that is the makings of a good stock, potentially. So quality, what does quality look like? It's really talking about balance sheet. So low debt on your balance sheet, strong balance sheet, a good quality balance sheet. You look for interest coverage ratios, you look for return on equity, and you look at things like the competitive advantage a company has. How strong is it? How strong is its brand? And if it's got a strong brand, if it's got high barriers to entry, if it's got good competitive advantages, then it is likely to have high margins. Okay, so those are all characteristics of a good quality company. Okay, some can be measured through indicators and numbers. Some can be measured through looking at that company's positioning in the market and its branding, competitive advantage, that sort of thing. Okay, value. Now, value is things like price to earnings ratio. It's really talking about what is the value of the company in terms of its earnings, in terms of its cash flow, in terms of its sales. So there are lots of different variations of a valuation metric. Okay, so all else being equal, you want the value of the company to be low price to earnings ratio, low price to book ratio, low price to sales, low price to cash flow. But you should also beware of what's called the value trap, which a lot of people, including professionals, get caught out by. Because if you simply look for companies with low valuations, anybody can do that, right? That doesn't necessarily guarantee you high performance, right? You need to marry up the value with the quality, with the growth, and with the momentum. So growth characteristics, well, earnings, historical. You look at its historical earnings growth. How much has that company grown by over the last 5-10 years? And then perhaps more importantly, what is its future earnings growth likely to be? Now, that is somewhat subjective, but somewhat depends on what its historical performance has been like. So the earnings growth is a very important characteristic, in many ways much more important than the value characteristic. And finally, momentum. So momentum is quite a simple attribute, actually. So it's very simple. Momentum is telling us, what is the share price momentum doing? If something's going up, it may continue to keep going up because it has momentum. We look at various things like moving averages, etc. We can drill down deeper into individual stocks, but actually, how do you find companies which sort of fulfill some of those criteria? Now, let's just have a look at quality and yield for now, right? So quality is one of the most effective characteristics of those four. So we can do screenings for quality stocks. In the same way you might go to Rightmove to look for properties based on certain parameters, you can go to various different screening tools, use different screening tools to find good quality companies. Okay, so what are we looking for? We're looking for sustainable businesses. We're looking for long-term winners, compounders over time. We're looking, as I mentioned, strong balance sheet, low debt. We're looking for high dividend yields. So in the UK, we're looking for at least 3% dividend yield, ideally much more. And in the US, we're looking for at least 1.5%, ideally much more. Okay, so based on historical screenings I've done. This isn't necessarily correct now because things change all the time, but this is an older screening I did. We found BATS, BAE Systems, Tate & Lyle, Johnson, Microsoft, PepsiCo, etc. So these are all big, high-quality blue-chip companies which have stood the test of time, which have delivered year after year after year, compounded up massively, also pay a dividend yield, have good balance sheets, etc. Historically, as I mentioned, I must stress, these are all screenings that have been produced historically, not necessarily now. We need to conduct fresh screenings in real time to do this exercise. Okay, so what kind of factors do we use? What are the parameters we put through our screening tools? Dividend yields. So the sweet spot in the UK is between 3 to 8%. Okay, obviously we would love a higher dividend yield, but beware, there's could be a bit of a value trap, a dividend trap. You can, if you looked for yields you can find 15, 20% yields. That's not sustainable. Okay, so the sweet spot is really somewhere between 3 to 8% in the UK or between 2 to 8% in the US. We're looking for dividend payout ratios. So, for example, what is a dividend payout ratio? Dividend payout ratio is how much of its profits is a company paying out. So we want that to be a reasonably modest level. We don't want it to be too high in the 90s or hundreds. We want a company to be paying out a reasonable amount of its dividends, but not everything. Because why not everything? Because if a company's profits drop one year, then it would have to drop its dividend payout. Whereas if it's at a moderate level, it has some safety margin there. So you want a payout ratio to be moderate. We want beta to be moderate as well, less than 1.1, for example. Beta is just a measure of how volatile a particular stock is compared to the index. Okay, we want a history of solid return on equity generation for that company. We want decent market cap. So these are just some of the indicators that we put through our screening tools to produce a list of high quality, solid blue chip companies, which we can then go and sell options on, use as underlyings for options. That's what we do. So those are quantitative factors. There are lots of qualitative factors, which we then look at. A low incidence of dividend cuts. We want companies not to be cutting dividends historically. We want companies to be ideally growing their dividend over time. We want a solid management team. We want companies which have sustainable business models, not just for now, but for going forward as well. We want companies with high barriers to entry, solid branding, competitive advantages, and we want a company with a history of free cash flow generation. So those are some of the things that we look for. And when we have these, we can then go to our options strategy, and we can have much higher confidence that these companies won't let us down and will produce reliable, dependable income going forward, both in terms of dividend yields and in terms of options income. Okay, when you create a smart portfolio, what are the results? The results are you are diversified and you're not leaking your wealth away. Okay, which is very important. You're not leaking away in fees, you're not leaking away in taxes unnecessarily, and you're not leaking away in inflation. We use ETF shares and options, very simple, and when we put them together, it becomes a very powerful combination of growth on the one hand and income on the other hand. And by doing what we've already talked about, by using Delta, by using some of those sort of risk management tools, by using strong stock screening techniques, we earn continuous income in terms of dividends, in terms of options income, and things like REITs. So it really is a powerful thing to understand and implement and learn initially, because that will give you continuous income and growth for very long periods of time on a sustainable basis without actually having to do a huge amount of work going forward. And really, that is the key. That is the key to your passive route to financial security and independence. So if you enjoyed that video, please do like and subscribe, and look out for our other videos. And I hope to see you next time.